Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. When you decide to invest in a business for the first time, it can feel exciting. You may see a promising company, hear an impressive business idea, or meet an entrepreneur who seems confident about the future. It is easy to imagine your investment growing quickly. But successful investing is not simply about finding an exciting opportunity. It is about understanding the business, managing risk, and making decisions based on facts rather than emotions. Many first-time business investors make mistakes because they focus too much on potential profits and not enough on the risks involved. In this video, we will look at some of the most common mistakes first-time business investors make and how you can avoid them. One of the biggest mistakes is investing without doing enough research. A business may have an attractive product, a popular social media presence, or a convincing owner, but those things do not automatically mean it is financially healthy. Before investing, you should understand how the business makes money, who its customers are, who its competitors are, and what makes it different. You should also examine its revenue, expenses, debts, cash flow, and growth history whenever those records are available. Research helps you see the complete picture instead of making a decision based on appearances. Another common mistake is investing because of emotions. Sometimes an investor becomes excited about a business because they personally love the product. While liking a product can be a positive sign, personal interest should not replace financial analysis. A product you love may not have enough customers to support a profitable business. Similarly, you might become impressed by an entrepreneur's personality and decide to invest because you trust them. Trust is important, but financial decisions should still be supported by evidence. First-time investors also sometimes put too much money into one business. They may believe they have found the perfect opportunity and decide to invest most of their available capital. The problem is that even a promising business can experience unexpected challenges. Customers can disappear, costs can increase, competitors can enter the market, or economic conditions can change. Diversification can help reduce the impact of one investment performing poorly. Instead of placing all your resources into one opportunity, consider how the investment fits into your overall financial plan. Another mistake is failing to understand how the investment actually works. Business investments can take many forms. You might purchase shares, provide a loan, become a partner, invest through a private agreement, or participate in another structure. Each arrangement can have different risks, rights, responsibilities, and potential returns. Before investing, make sure you understand exactly what you are receiving in exchange for your money. Do not invest simply because the opportunity sounds profitable. A related mistake is ignoring the investment agreement. Some investors focus so much on the potential return that they barely examine the terms. This can become a serious problem later. Important details may include ownership percentage, voting rights, profit distribution, repayment terms, exit conditions, responsibilities, and what happens if the business needs additional funding. Never assume that everything will work out exactly as discussed verbally. Important agreements should be clearly documented, and professional advice may be appropriate for significant investments. Another mistake is underestimating the importance of cash flow. A business can have impressive sales and still struggle financially if it spends too much money or has difficulty collecting payments. Revenue tells you how much money comes into the business, but cash flow helps show whether the company can meet its financial obligations. Investors should pay attention to whether the business has enough cash to operate, grow, and handle unexpected expenses. A company that constantly needs new money just to survive may carry more risk than it initially appears. First-time investors may also make the mistake of chasing high returns without considering risk. When someone promises extraordinary profits with little or no risk, that should immediately raise questions. Higher potential returns usually come with higher uncertainty. Instead of asking only how much money you could make, ask how much you could lose and how likely that loss might be. A realistic investment decision considers both potential rewards and potential downside. Another important mistake is failing to have an exit strategy. Before investing, you should understand how you might eventually get your money back. Depending on the investment, your options could include selling your ownership, receiving distributions, getting loan repayments, or waiting for a larger transaction involving the business. Some business investments can be difficult to sell quickly, so investors should understand the level of liquidity before committing their money. Many beginners also fail to monitor their investment after putting their money into a business. Investing is not always a situation where you give someone money and forget about it. Depending on your agreement and level of involvement, you may need to review financial reports, business performance, major changes, and future plans. Monitoring does not mean interfering with every decision. It means staying informed enough to recognize whether the business is moving in the direction you expected. Finally, one of the most dangerous mistakes is investing money that you cannot afford to lose. Every investment carries some level of risk, and business investments can be particularly uncertain. You should consider your personal financial responsibilities, emergency savings, existing debts, and long-term goals before committing capital. An investment should not put your essential expenses or financial security at risk. The good news is that most of these mistakes can be avoided with patience and preparation. You do not need to be an expert before making your first investment, but you should be willing to learn. Research the business, understand the financial information, evaluate the risks, read the agreement carefully, consider diversification, and never allow excitement to replace careful analysis. Remember, successful investing is not about finding an opportunity that guarantees huge profits. There are no guaranteed investments without risk. Good investing is about making informed decisions, protecting your capital, understanding what you are investing in, and giving yourself the best possible chance of achieving your financial goals. If you are considering your first business investment, take your time. Ask questions, verify information, and seek qualified professional advice when necessary. The more carefully you evaluate an opportunity before investing, the better prepared you will be for whatever happens afterward. Your first investment does not need to be the biggest one. It needs to be one that teaches you how to make smarter decisions for the future. Please like, share, and subscribe for more exclusive content.